Important points with respect to Singapore in terms of understanding the procedure of registering an entity in Singapore. We will also touch upon on visa requirements for entrepreneurs in Singapore. We would discuss about grants available for global entrepreneurs in Singapore, and we will also do in detail comparison analysis of tax and compliance structure between India and Singapore. So these are the points which we would discuss today in detail. I hope that you are able to see our screen. So a brief about Singapore, why Singapore is being preferred by global entrepreneurs, and why Singapore has become so preferred location for entrepreneurs in specific is because of these rankings and because of these parameters wherein Singapore have performed very well. Some of the benefits of Singapore as a jurisdiction is it's a well-developed economy backed by strong financial system. The registration process is very simple in terms of its location. It's strategically located in the ASEAN and APAC region. Well-functioning, stable government, a very robust and upgrowing startup ecosystem in healthcare, in tech, disruptive tech ecosystem per se, and low tax and interest rate. So I will start with.
Yeah. So
I will start with. Let me now pass on to Soumik. He would help you to understand registrations and how do you start an entity in Singapore.
Yeah, thanks, Alok. So basically, unlike India, there are very few documents required to register your entity in Singapore. To take this into perspective, we would require only the passport copy and the latest utility bill, and that would be it. And no further documents that are required from our side. The ACRA, for example, the regulatory body in Singapore will approve your form if they go through it in detail, and those two documents will be needed. And very important point to take this into perspective. One thing, no apostillation and notary will be required to get this, and of course, the share capital being a very important point. The share capital you can start with as low as $1, and your shareholder can be only 1%. Unlike in India, where you need to have at least 2 directors, 2 shareholders, it is not required over there. You can start your company with only 1 shareholder, and a nominee director will do the work for the directorship. You can even register your entity in just a day. The government fees, a very important point over here. In India, we have to pay the government fees first, and in case it is not registered, the entire government fees is forfeited. However, in case of Singapore, this is not the case. You have to register your entity, and then only you have to pay the government fees to the ACRA. In India, you would have different type of licenses like P-tax, trade licenses, and different other sort of like shop and establishment also. But in Singapore, there is only one registration, that is ACRA, and you can initiate a business with it, and no further registrations will be required. Now let me loop in my colleague Navneet.
So Soumik, a few things which I want to clear. So basically what Soumik is saying that 100% for foreign holding is permissible in Singapore. So Indian, if they are going and registering, they can own 100% as capital. One person can incorporate a private limited company in Singapore. What you need is two directors, and one of the director has to be a resident director in Singapore. So basically you need someone in Singapore to be a director. That person is called nominee director, who would do the day-to-day activities of the company. Yeah. So Navneet, now you can take it forward.
Yeah.
Thanks, Alok. So here now we go with the Singapore compliances. We find that there are various kinds of compliances, such as we need to file the annual tax returns with the Inland Revenue Authority, that is of Singapore, that is IRA, and then we need to, just like we do in India as well. For that matter, we also need to file the annual returns with the Accounting Corporate Regulatory Authority, the ACRA. Other than that, the PF and ESI, which is known in Singapore, is known as like Central Provident Fund and Skill Development Fund. So we need to do the registration with them. And obviously, the most important is like we need to maintain the books of accounts and the accounting records for companies. And also, the GST registration is one of the important parts. Like if the revenue exceeds $1 million, then we need to even go ahead with the registration of GST. So in one financial year, we check like if the revenue exceeds $1 million. We check if the revenue exceeds $1 million in any financial year, we go ahead with the registration of GST as well.
So basically what Navneet is saying, unlike in India where you have to cross the 40 lakh rupees limit and you have to go for GST registration, in Singapore on that thing, yes, it is $1 million, which is roughly around 5 crore. Right. Coming to the next point.
So now let's move on with the tax slab and exemption in Singapore. So the advantages, as we can see in Singapore, is that it has one of the lowest tax rates in Asia, that is flat 17% corporate tax rate. Other than that, like there are two kinds of exemptions basically for the startups and for the existing companies, like which have already been into place for more than 3 years. So first one, if we see, it's tax exemption for the startup companies, in which I'll explain the limits later on. So there is a tax exemption for those new startup companies, and also partial tax exemption for the existing companies which have been in performance after 3 years. Like they enjoy the partial tax exemption as well. And as far as the losses to be carried forward, we see that losses can be carried forward to offset them with the future profits. Basically, the set off of losses.
Right. So just to take this into perspective, we can initiate. So there are two types of tax slab over here. One, your exemption is given right from the first year, so the first 3 years,
yes,
and then there is another sort of exemption which is for partial
fourth year onward.
Yes. So we will discuss this in detail. Let us go to the next slide where we are trying to compare Singapore
vis-a-vis India. We compare it. We compare the tax rates and the structures. Basically, there is a slab-wise tax exemption on corporates in Singapore, but for India, we find there is no such slab for tax exemption purpose. There's a flat tax rate of 25% in India, and the corporate tax rate in Singapore is 17%. So also, if we see the capital gain tax, there is no concept of tax on capital gains in Singapore. But for India, if we go ahead with the sale of shares, securities, or mutual funds, where those are taxable in India. And the GST rate, which is one of the lowest in the world, it's 7% for Singapore, which is very low. And as far as Indian GST is concerned, it's basically based on a slab that is of 5%, 12%, 18%, and the highest rate being 28%. So there is a huge difference we can see, like in terms of the tax rates and structure, and Singapore leads a much at a better position than India.
Yeah. Now let's compare this by giving you an example. Over here, we are starting saying that both companies, both in Singapore as well as India, earns a profit, that is PBIT, after.
Basically, it's a mathematical example that we have taken. So we need to see like what would be the ultimately effective tax rate for both the economies when we compare the tax rate. So for that matter, we have taken $1 million as the chargeable income for both the countries to keep it on a parity. And
so, Navneet, I think at this point of time, let us first rewind what all we have covered up to now. What we have covered as of now is the requirement, the process to register a company in Singapore. We have covered in terms of the compliances, what is required in terms of GST, maintenance of books of accounts, filing of return with ECRA. We have also covered and we have given a tax slab and exemption details with regard to Singapore in terms of the tax rate, exemptions to startup companies, corporate losses to be carried forward. And we have also discussed in respect of, now we would discuss in respect of a specific comparison between India and Singapore. We are analyzing as such how India is different from Singapore in terms of slabs. So in India, there are no slab system for corporate tax. Companies and businesses are taxed at a flat rate of either 25% or 30%. If it's a foreign company, then 40%. But in Singapore, there is a slab with respect to in terms of revenue and profitability, and different slabs are there. There is no capital gain in Singapore. Now this is very, very interesting, and this is very, very interesting, and because of this, many companies do get attracted to register in Singapore. There is no capital gain concept, so tax is only on income and not on capital which we generate. And because of that, many companies do register in Singapore. Because of this, many IPs get generated in Singapore, and they move their IP and intellectual property right to Singapore. So that is one thing. In Singapore, there is a flat rate of 7% of GST. Compared to India, the average rate in India would be around 18%, 12 to 18%, highest being 28%. Corporate tax I have already explained. So Navneet will give a practical example of a difference with the tax rate, how India and Singapore plays in terms of the tax rate. Yeah, Navneet.
Yeah. So now, like, we are comparing the two economies on the basis of the tax rates, and we have taken a mathematical example for that. So if we take say there is a company A which is incorporated in Singapore on 1st July, and the first financial year in that case would be 30th June 2019. So it's exactly 1 year. So, and we take on an assumption basis, we have taken the chargeable income as $1 million in both the cases, obviously, to bring it on a parity. And there's if we see the tax exemption, in Singapore, we know it's like they will get a tax exemption as a starter for first 3 years. But in India, the exemption will be given only if the certificate is obtained from the IMB. So now, so now when we go to calculate the tax, the rule is that on first $1 lakh, there is an exemption of 75%. So on first $1 lakh, the 75% comes to $75,000. And on the next $1 lakh, so this is the slab we are talking about. So next $1 lakh, there is a exemption of 50%. So that comes to $50,000. So here now when we see the total exemption amount, it comes to $75,000 plus $50,000, which comes to $1,25,000. Now, as we have taken the income as $1 million, we find that from this $1 million, $1,25,000 gets exempted. So we need to pay the tax only on the chargeable amount, and now our chargeable income after the tax exemption, that is $1 million minus $1,25,000, it comes to $8,75,000, and a flat rate of 17% as discussed earlier, which when applied on $8,75,000, which is the chargeable income, it comes to $1,48,750, which in INR would be converted to somewhere around 74 lakhs rupees. So now what we find is that if we see the effective tax rate, that is after taking the exemption, we find that the effective tax rate would get reduced to even lesser than 17%, which would be roughly 14.88%. So this is basically calculated as total tax, which is $1,48,750 on $1 million. That was the total income. So here we get the effective tax rate as 14.88%. And now this was about Singapore, like how the tax is calculated, taking the exemption limit and accordingly the chargeable income. Now when we come to India, first we need to check, we need to take one assumption that the turnover for previous year is not exceeding rupees 250 crores, because we have taken the tax rate as 25% and not 30%. Had the case been that the turnover would have exceeded rupees 250 crores, we would have taken the tax rate as 30%. But here we are considering in our example as 25%. That is, the turnover is okay. Yeah, turnover we see that it comes to exactly 5 crore rupees. We take here, we have assumed the Singapore dollar rate like as 50. So $1 million, which when multiplied by 50, it comes to rupees 5 crores. So now we are calculating this the tax on this rupees 5 crores. So on rupees 5 crores, we find that if the income tax is taken as 25%, it comes to 1 crore 25 lakhs as the income tax. And now, as we know that the surcharge would also get applicable, since the turnover is more than 1 crore and less than 10 crores, the surcharge at 7% would get applicable. And had the case been that the turnover would have been above 10 crores, the surcharge would have to be taken as 12%. However, in our case, we are taking it as 7% as it is less than 10 crores. And on 1,25,000, if we take the surcharge, it comes to 8,75,000 rupees. And now, with the recent amendment in the Finance Act, we find that the health and the secondary and educational cess, the name has been changed to health and educational cess, and the rate has been changed from 3% to 4%. So on taking this 4% into consideration, we find that the health and education cess would be 5,35,000. So in all, we see that the total tax comes to 1 crore 39 lakhs 10,000 on the mathematical calculation. If we find that is the income tax payable, which was 1 crore 25 lakhs, plus the surcharge and plus the health and educational cess as discussed earlier, it comes to 1 crore 39 lakhs 10,000. Now this was when we take the tax on the basis of normal corporate tax. However, in India, there is also a concept called minimum alternate tax, that is MAT, under section 115JB of the Income Tax Act. Here what we do is we need to calculate the tax, the minimum alternate tax as well along with the normal corporate tax, because at times it can so happen that we get the tax in corporate as per corporate tax slab. We find that it could turn up to be a loss, and since the term is given as minimum alternate tax, we need to pay a minimum tax to the government. So here in this case, we find that yes, we need to calculate the tax on the book profit, that is again considered to be 5 crores. So, and the rate of MAT is 18.5% in India. So the earlier tax rate, for the corporate tax rate was 25%, but on MAT it's 18.5% of the book profit. So now when we take the book profit into consideration, and when we take it as 5 crore rupees, as in our earlier example, we find that the tax comes to 92,50,000, and just as we did in the previous example, we add up the surcharge and the health and education cess, and the total tax payable, which comes under MAT, that is 115JB, it comes to 1 crore 2,93,400. So effectively, we find that it's much lower than the normal corporate tax. But the rule says that we need to pay the tax which is higher of A and B as in corporate tax rate and tax rate as per and tax as per MAT. So we need to pay the higher of the two, and which comes to ultimately 1 crore 39 lakh 10,000. Now, when we compare this 1 crore 39 lakh 10,000, the effective tax rate we find is on 5 crore rupees, it comes to 27.82%, which is very high as compared to Singapore. Right. And in Singapore, we also have a rule that if a company is into it, also, when we come to tax slab and exemption for companies which have been incorporated and have completed 3 years after incorporation, they would enjoy the partial tax exemption. So this concept is not there in India. It's just for Singapore that there is a partial tax exemption as well. And here now it is almost calculated in a similar fashion as we did for the startup companies. The only difference is that the slab gets changed. So there it was for first $1 lakh, it was 75%. Here it's 1 lakh. Here it's on first 10,000 at 75%. So it comes to $7,500. And the second slab, which was next 1 lakh at 50% for the previous one, that is the startup companies. Here it's next 1 lakh 90,000 at 50%, which comes to 95,000. So here the total exemption that we get is $1,02,500. Now again, which when converted to now we need to calculate the chargeable income tax, so like chargeable income. So which when deducted from $1 million, as in our previous example, it comes to 8,97,500. Now we need to pay the tax on this $8,97,500, which comes to 1,52,575. That is roughly at the rate 70% when calculated, and in terms of INR, like if it gets converted, roughly around 76 lakhs rupees. So here we find that the effective tax rate is 15.26%. And as far as Indian tax law is concerned, as I told earlier, like it would be same as the previous example, that is the effective tax rate was 27.82%. So now this is just a basically final comparison. If we take the taxable income, just as I can say a snapshot for the entire explanation. If we take the taxable income as 5 crore rupees for both Singapore as well as India to keep a parity, the effective tax rate for first 3 years would be 14.88% under Singapore taxation rules and 27.82% under Indian taxation rules. And the effective tax rate from fourth year onwards, it would be 15.26% for Singapore and 27.82%, which would remain the same under India. So we find Singapore is at a advantageous position than India as far as tax rate is concerned.
Yeah. So thanks, Navneet. Basically, as Navneet has said, the tax rate in comparison to Singapore, India's tax rate is almost half, right? Now, let's go into the RBI compliance part. If we see RBI compliance, we have to do an ODI compliance post investment to any foreign entity, right? So let me open the form that has been filed to the Reserve Bank of India. The Reserve Bank of India says that when you invest in a foreign entity, you file an ODI form through your AD bank. So who is AD bank? Basically the bank who is transferring the money from your account or your company's account to your foreign entities, that is your Singapore's company's account. So you must be very, very particular, because if you do not file this form, you are not in compliance with our FEMA rules. Just to take this into perspective, it is not only for Singapore, but for any entity. If you have any outside India and if you are a resident Indian, then you have to file ODI form to the Reserve Bank of India through your AD bank. Now, just to give you a brief note about this, how do we file ODI form? You must recollect that ODI form are of various parts. Right now we have to file ODI part 1. Generically, your company name, your address, stuff is given. The net worth is very, very important. This has to be filed. The net worth of yours and your subsidiary has to be given over here. The paid-up capital of the company and the balance sheet and everything should continue as it is. Coming back to the point where a very crucial point where an auditor has to point out in ODI part 5E, and there are various nitty-gritties. We will come to it in detailed discussion in some other webinar, which will come back shortly. Now let's go to the next point where where we have to file annual performance report after the subsidiary end of financial year of the subsidiary. So this about it, and once this is done, we are good with compliance of the RBI. Now let's come to the next point, which is of the visa regulation. For visa regulations, there are two types of visa that will be applicable in your case, where a Singapore where an entrepreneur or an employee have to get a visa, right? So there are employment pass holder and a dependent visa, dependent pass holder's visa. Now for employment pass holder, the guideline says if you are an entrepreneur or a locally incorporated Singapore entity who would be hiring employee from overseas, or if you're an employee getting an employment offer, all three person can apply for visa. The visa will they will consider the Ministry of Manpower is the body who will look into your application. The Ministry of Manpower will check your the qualification, very important, your work experience, the job scope, the economic contribution you are making to Singapore, and your employer track record while giving the employment pass visa. Now this has to be very carefully filled up and filed through the Ministry of Manpower's portal, so much so that there are no rejections. Now what is the time frame if anybody asks to provide to complete the process? It takes around 6 to 8 weeks, and the first time applicant will get it for roughly 2 years, and the EP renewals, that is the employment pass renewals, will be up to 3 years. Now coming back to the dependent pass, one of the for a dependent pass holders are people who are dependent on a EP for their financially or their safekeeping. So this pass is given to EP holders who are dependent of the EP holders who earn more than 6,000 Singapore dollars per month. Now, who are the people who will get it? The spouse, the unmarried children up to 21 years, including the legally adopted children. And as a DP holder, your spouse may legally work in Singapore. However, his or her prospective employer is required to apply for a letter of consent with the Ministry of Manpower before she commences work. So this is very important while applying and keeping your DP pass. Now, coming to a very integral part of the seminar, which is grants. The Singapore government gives lot of grants to global entrepreneurs. In India, where we see entrepreneurs, the grants or whatever is given is more focused on resident entrepreneurs. But in Singapore, there are various grants that are open for all sort of entrepreneurs, including global entrepreneurs. So in this seminar, we are focusing only for global entrepreneurs perspective. So why should one go for grants and not go for VC funding? To start with, in usual cases, not always so, but in usual cases, there is no dilution of equity. So you do not have to dilute your equity to get the grant. You do not have to repay them. That's a very big perspective. In case of a debt, which people go if they do not want to raise funds, they go for debt, you have to pay interest. But in case of grants, you do not have to pay interest. Many grants that we will speak later today, they provide also strategic connect with concerned people, and they also provide technical know-how. So not only they will give you money, but they will also help you to connect with people through which you can generate your revenue or reduce your expenses. Let's go one by one. Let's first start with Enterprise Development Grant. Now, this development grant has been recently come into the picture, but previously it was named as something different. It has just replaced the Capacity Development Grant, which was very famous and well reputed among global entrepreneurs in Singapore. This grant has three crucial pillars, and this grant helps you to upgrade your entire business in three crucial ways. One, it helps you to increase your core capabilities. B, it will help you to innovate and make your productivity at a much bigger scale. And three, it will help you to go for a market access. Not only they will give you the money, but they will also help you in three this type of things. Now, how does the grant help? The grant gives 70% of the qualifying project cost. So basically, when you there are various project costs that are taking the picture, and this grant will provide you the financial backing to it. So if you have expenses of say $10,000 Singapore dollars, this grant will pay 70% and you have to pay 30%. Now, of course, over here the word qualifying cost is very important. It's not all expenses, but there are specific expenses. So what sort of expenses we are talking about? We are talking about the third-party consultancy fees. You have to pay for global entrepreneurs. You have to pay your consultants, your legal advisors, financial advisors, or say your tech advisors. Now, this type of advisory fees, they will pay 70%. They will even pay your software and equipment fee and incremental internal manpower cost. So basically, if your manpower cost increases, they will fund a certain portion of it. Now, the global entrepreneurs must come into picture of this point, which is the eligibility criteria of this type of grant. Point 1, it must be your entity must be registered and operating in Singapore. What does this mean? Not only registration is important, your operation should also be in Singapore. In India, like many companies have their front office and entire office, only the virtual office in Singapore, and the entire office is from a different region. That won't happen. You have to have the entire office, at least the majority part, in Singapore. B, you have to have a 30% local shareholding. You may own 70%, no issues, but the local shareholder must own 30%. And you must be in a financial viable position to start and complete the project. So what happens is that many entrepreneurs think when you apply the grant, there are chances of you getting is very high. But when the ministry or the concerned authority vets your project, they will see, are you in a financial position to start and complete the project if they fund you with the 70% fund. So when you apply for this grant, you must make sure this grant, you are in a position to give the 30% money. Now, what is Startup SGTech? This is the second sort of funding thing. This gives you funding in two various stages. First, proof of concept, where your concept will be checked whether you would get or not. The proof of concept gives you a fund of $250,000. That's $250,000 to start with. And if your project is far more important, that is your proof of viability is done, then you would get funding of up to 500,000 SGD. So basically, it's $250,000 plus $500,000 you can get. Now again, there is a eligibility criteria over in this SGTech also, which focuses on fast-track development of proprietary technology. Asks you to get a 30% shareholding for your local shareholder, and the company group sales turnover is not $100 million or does not employ more than 200 workers currently. The application must be a private limited company, that is a PTE entity in Singapore, and should have been established for 5 years or less to take the grant of this application. Coming to the next point of Financial Sector Technology and Innovation Fund. Now, this is a massive scale fund that has been announced by the Monetary Authority of Singapore. In various ways, the MAS is trying to upgrade and to create a vibrant ecosystem on fintech. So anybody or any startups who are thinking to have a fintech company in Singapore, so this is the right time because they have a corpus of $225 million allocated just for FTSI. Now, you must remember, not every fintech startup would be eligible. There are two basic eligibility criteria. Point 1, the companies must be either a financial institution licensed, regulated, supervised or registered in Singapore, or a technology or solution with at least one financial institution licensed, regulated, supervised or registered by MAS sponsoring the project. Now, you must understand if you are a tech company into fintech, one financial institution just have to sponsor your project and that's it. You would be getting, or you would be having a high chance of getting a corpus of a few $1 million for your project. In this project, sponsors need not give a direct financial stake in the project, but must exhibit active engagement or commitment to see the project. So basically, your sponsor should not, does not have to take a stake. It's just they would take a sufficient, if they give some interest, that would be it. Now, how do they finalize this? There will be type of project. So they have divided into two different type of things. One is investigative project. One is technical equivalence trial. In both the things, they would give you a support after they go to the details which I have already mentioned in my PPT, where I say projects which will develop a novel concept, they will fund 50%, which may even go to more than 500,000 SGD, and in the second portion, which is 70% of 200,000 SGD. Coming to the next point of seed capital and startup SG. This particular fund takes equity. What they do is that they invest in companies, or they match or collaborate with other VC funds and give an equal amount of money. They match to a portion of the dollar for their entities, the way the VC funds will invest. What are the eligibility criteria? A Singapore-based company with core objectives carried out there. Startup should not be a subsidiary or a joint venture. So basically, you have to have individual holding over here. Incorporate a private limited company less than 5 years, similar to my previous slides also. It should have a 50,000 SGD paid up capital and a proof of substantial innovation of intellectual content and growth potential. They must show growth potential. So basically, if you are a tech company with high growth potential, this particular grant is for you, where the Singapore government will match for every funding that you are doing. What are the considerations they would include? They would see how independent third-party investor is, and business must not be involved in following business activities like gambling, tobacco-related products. These are the things that are that won't get the seed capital or startup SG equity fund. What is how these things operate? This has a particular way, that is general tech and deep tech. For both the things, they will give you an investment. Investment cap for each startup will be going for $2 million and $4 million for general tech and deep tech respectively. And if they, for example, have a co-investor, they co-invest with somebody, they would give 7:3 ratio from seed capital, and then after 250K, they would have 1:1. So this is similar to deep tech also. The difference being from 250K, you would be getting 500K. Their co-investment approaches are similar, where they can find a third-party investor, or startups can find a third-party investor themselves, and then they can approach Spring Seeds to match their investment. Coming to productivity solution, over here, again, an IT-based grant is given, and they would give you a 70% qualifying cost reduction for your expenses that you have incurred. In this particular type of grant, not all businesses are eligible. There are particular limits. SMEs can apply for TSC if they meet the following criteria: that is, registered and operating in Singapore, purchase, lease, subscription of the IT solutions, must be used in Singapore. That is, your solutions that has been provided should be used in Singapore and have a minimum of 30%. Like in most of the cases, you must have 30% local shareholding, but it is not for all. It is for selected solutions. So basically, for global entrepreneurs who doesn't have a 30% shareholding, this can be a very good alternative to get grants. Market readiness assistance is given to companies where you are testing the market and how soon your product can be launched in the market. They give grants up to a particular limit, which is around 20K per fiscal. Eligibility of 70% will be there. Per year, you can give only one application, 1 year, one activity, and maximum 2 applications can be given per fiscal, right? This, coming to the next point of business improvement fund, this will be the last point for the grant. In this particular business improvement fund, it is given only to companies who are into tourism sector. So basically, if your solution or if your product is giving solution to tourism sector, this can be a very, very good alternative. This fund helps you to expand your market in various ways. The benefit is 70% funding support for qualifying costs. Not again, over here, qualifying cost is very important. For non-SMEs, they will give you 50% support for qualifying cost. And now, what are the qualifying costs? If you see, there are very few qualifying costs that are given over here. One being your third-party project that you would undertake your professional services, like in case of a consultant, and where you would getting the testing and certification. All those things will be included. However, your maintenance cost or marketing cost will not be covered into either 70% or 50% eligibility clause. So basically, if you have fund which is more into marketing, they will not give you the fund. But if you are more into tech-based thing, which is into tourism sector, they will be happy to give you the fund accordingly. So this is done for grant phase.
That's it for today, friends. Thanks for joining in. We will share the video recording of this webinar, and if you have any query with regard to Singapore registration, we do provide comprehensive help in terms of setting up in Singapore nominee directorship and all the allied services around it. So we can be more than happy to help you. Do write to us on our email ID, which is info@taxmantra.com. You can visit our website also, and we will share this video. You can even reply to the email wherein we will share the video also. So that's it for today. Please send your questions if you have any, and we will be more than happy to answer those. Bye till we come up with again with another webinar. Thank you.
Thanks.
Ready.